All right, let's jump right in. Welcome to today's explainer. Today, we're looking at a genuinely fascinating piece of legal and financial machinery. For high net worth individuals, global nomads, or really anyone doing serious business across borders, understanding this mathematical test is often the literal difference between keeping your wealth or facing massive, completely unexpected tax liabilities. We're taking a stance of absolute clinical objectivity today to deeply analyze an anonymous expert report detailing what's known as the significant asset test. Now, on the surface, I know, it sounds like a dry accounting term, but it's actually a highly sophisticated mechanism used by jurisdictions to determine your tax residency. We're going to act as a specialized analytical engine for this one, filtering out all the noise to look at the core ideas, the hidden mechanisms, and the crucial cause and effect relationships that govern this test. We aren't just looking at the rules, we're looking for the implicit assumptions the law makes about human behavior. So here is our analytical roadmap for the explainer. We'll start with the absolute foundational quantitative rules, the pure math. From there, we'll move into temporal boundaries, explore conditional exemptions, and finally, analyze the systemic treaty overrides that can completely upend the entire equation. Okay, part one, the core mathematical formula. We are looking at the quantitative baselines for determining residency. So, to the focused learners out there, what exact metric actually drives this thing? Fundamentally, it measures the fractional accumulation of your physical presence over time. Notice the implicit assumption here, because it's a big one. The law completely ignores your personal intentions. This system literally does not care if you intend to live in a jurisdiction forever or if you actively despise the weather and can't wait to leave. It only cares about the raw data of your physical footprint on a calendar. The logic is incredibly simple. Intentions are easy to fake, footprints are not. And that brings us to the magic number, 183. This is the multi-year statutory threshold. Now, why 183? Well, because it represents just over half of a standard year. The implicit legal assumption is that exceeding this exact calculated number of days fundamentally flips a legal switch. You're no longer classified as a mere visitor passing through. You've spent enough physical time on the ground to be categorized as an integrated economic contributor to that jurisdiction. But as the expert data reveals, reaching that 183-day threshold is absolutely not a simple, straight count. Before that 183-day engine even has a chance to turn on, there is an absolute base requirement. The mechanism only activates if the individual is physically present for at least 31 days in the current calendar year. This is a highly actionable, totally non-obvious detail. The 31-day rule is essentially the gatekeeper to the entire formula. Mathematically speaking, if you strictly cap your presence in a jurisdiction to exactly 30 days or fewer, the multi-year calculation engine remains completely dormant. And that's regardless of how much time you spent there in previous years. Now let's see how this actually builds, because this is where the math gets really interesting. The test doesn't just look at an isolated year. It looks at a rolling 3-year period using a fractional multiplier. Days in the current year are counted at 100%, but the formula applies a specific decay factor to your history. Days from the first prior year are weighted at 1/3. Days from the second prior year are weighted at 1/6. There's a deep systemic logic to this depreciation. The state is operating on the assumption that the further back in time your physical presence was, the less relevant it is to your actual economic integration today. Let's look at how this math functions in reality based on the expert data. To truly internalize the cause and effect here, let's walk through a methodical calculation. Imagine an individual spends exactly 150 days in the jurisdiction for 3 consecutive years. In the current year, you count all 150 days. For the first prior year, you multiply 150 by 1/3, which gives you exactly 50 days. For the second prior year, you multiply 150 by 1/6, resulting in 25 days. Now add those weighted values together. 150 plus 50 plus 25 equals 225 days. The result? You have mathematically breached the 183-day threshold even though you technically never spent 183 days in the jurisdiction during any single calendar year. The cumulative weight of your history triggers the trap. Moving right along to Section 2, Temporal Boundaries and Triggers. We need to establish the exact legal timeline. So the mathematical engine is clear, but how does the system actually define a day? We really need to nail down the legal parameters of presence. According to the analysis, it means your actual physical location on the ground. But here's a key actionable insight. It's about what the law implicitly excludes. Time spent flying over territorial airspace or sitting in a designated transit zone does not trigger the calculation. You could theoretically spend 12 hours drinking terrible coffee in an international airport terminal, and to the eyes of this tax formula, you're an economic ghost. Mere transit is mathematically invisible to the test. And this definition creates a very strict cause and effect timeline. Residency typically begins on day 1 of actual physical presence. The clock starts ticking the absolute second you step out of that transit zone. Conversely, the residency end date is typically the last day of physical presence in that calendar year. But crucially, this assumes you actually sever permanent ties. It's not just about getting on an airplane to leave. It is about the legal cause and effect of permanently ending your economic connection to the jurisdiction in order to fully stop that residency clock. All right, Section 3, the de minimis exemption, otherwise known as the 10-day conditional rule. What if you're just passing through for a quick meeting before a permanent move later? Well, this brings us to the first conditional exemption, a fascinating loophole. The absolute limit for this specific rule is exactly 10 days. Why so narrow? Well, it's explicitly designed to accommodate brief, necessary business trips or sudden emergencies without instantly triggering a massive tax headache for the individual. However, make no mistake, the state keeps this on a very tight 10-day leash to prevent systemic abuse. This brilliantly illustrates the precision of tax logic. Here's the exact cause and effect relationship. If you're present for under 10 days and you can prove you maintain a primary foreign tax home, which basically implies paying taxes elsewhere and keeping your main residence abroad, those initial days are ignored for triggering your official residency start date. However, and this is absolutely crucial, those days are never erased from the core mathematical engine. They still count toward your total 183-day calculation. It's essentially a shield for your timeline, not an eraser for your data. Let's pivot to Section 4, the closer connection rule. These are the qualitative overrides to the quantitative results. Now we're shifting our focus from pure numbers to actual human behavior. What happens when the qualitative facts of your life clash with the quantitative results of the formula? So if you breach that 183-day threshold, you can still escape residency if you meet a heavy burden of proof. You have to prove 3 actionable requirements. You maintain a primary tax home elsewhere, you have stronger economic ties abroad, and your family connections are rooted in that foreign jurisdiction. How do you prove this? By showing where your business is actually incorporated, where your immediate family lives, where you hold your driver's license, and even where you vote. We're no longer simply counting days on a calendar. We're weighing the absolute center of gravity of your life. And here is the fundamental contradiction at the heart of the system. You can meet the mathematical qualification perfectly, but your legal classification can still remain as a non-resident. The law implicitly acknowledges that math alone cannot perfectly map complex human economic behavior. Qualitative reality can override quantitative fact. Why does this matter to you? Because it means that even if a strict bureaucratic spreadsheet says you owe taxes, a well-documented, meticulously structured life can legally overrule that spreadsheet. But do not miss this non-obvious detail highlighted in the expert report. This closer connection exemption, it's absolutely not an automatic right magically granted by the state upon discovering your foreign ties. It requires proactive action. You literally have to actively assert your qualitative reality against the system by filing formal election paperwork. If you miss the absolute original legal deadline to file this form, the mathematical formula wins by default. Why? Simply because bureaucracies will always favor their own math. Okay, our final section, number 5, continuity and treaty overrides, the systemic guardrails. We've seen the engine, we've seen the manual overrides, now let's look at the systemic guardrails that govern the ultimate application of the test. First up is the no-lapse rule. Think of this as a structural anti-loophole mechanism. If you are a resident in a prior year and you are present in the current year, the system forces your resident status to begin on January 1st of the current year. The state actually anticipates human behavior here. They know people might try to temporarily step out of the jurisdiction in January just to artificially reset their tax clock for the new year. This guardrail is explicitly built to prevent those artificial gaps in continuity. So when an analytical expert looks at a complex case, they follow this exact escalation path in the legal architecture. Step 1, run the fractional math. Step 2, apply domestic qualitative exemptions like the closer connection rule. But if all else fails, you escalate to step 3, which is the ultimate authority in this space, international treaty overrides. As the expert report explicitly notes, international treaties can nullify the physical presence formula entirely if a permanent home and primary ties exist in another jurisdiction. Why do treaties win out? Because of the implicit assumption that sovereign agreements negotiated between nations legally superseded any internal domestic counting games. Here's your final actionable insight regarding these treaty tiebreaker rules. They function strictly to determine tax liability. Activating a treaty does not magically change your physical day count. It just legally changes where the money flows. Even if the significant asset test definitively proves you're a resident, a treaty can allow you to elect non-resident status for tax purposes. It is the absolute final safety valve in a highly rigid system. Which leads us to this final thought to ponder. We started this explainer by looking at a rigid, fraction-based mathematical formula. But step by step, we've seen that those absolute numbers can be completely bypassed by proof of human connections or swept away entirely by sovereign international treaties. So is legal residency ultimately a mathematical certainty, or is it merely a behavioral interpretation? It really changes how you view the intersection of math and law, doesn't it? Thanks for joining me for this explainer. Keep analyzing the systems around you, and I'll catch you next time.